So, hello, and a massive hello to everybody. Hope we're all having a great day wherever you are, whatever you may be doing. So, here we go 50 pips, rocking and rolling, no trade calls, no recommendations, every response for their own stuff. We're here for educational purpose only. Quick little update since markets are fairly slow. We do have some movement, but nothing crazy. So, I thought we'd do a little bit of a live update and try and pay it forwards a little bit. So, if anybody has any comments, anything they want to look at, anything they want to discuss, just hit me up, and we'll tackle as much stuff as we can. If nobody asks any questions, I'm going to just shut it down and go back to trading. But yeah, sure. Hey man, how's it going? Yeah, here the base case expectation is that we're going into a little bit of a funky week, right? We've got a lot of news on deck, but essentially what's happening is it's a wait and see until we get into, we get past this G20 meeting, right? We've got a lot of headline risk out of Iran, a lot of headline risk out of China, et cetera, et cetera, et cetera. Usually your base case expectation would be that going into the week after June expiry, OPEX, quad witching, triple witching, whatever you want to call it, seasonals are not that strong, so market tends to be down. Again, we've got a tweak to change this, but you would not expect this to be a massive week. You'd expect stocks to trade sideways to down. Also, what's interesting is that we're going to be slowly going towards earnings. So again, we're not expecting to see awesome earnings, so that could weigh on the market. I mean, in an ideal world, if you think about it in terms of textbook action, you'd expect this week to be sideways to down, lackluster, that any kind of tweet tries to pump this up, then maybe we get something over the G20, maybe a deal, God knows what. We ramp up, put in some kind of a swing high in the beginning of July, of the week into 4th of July. And then as we have all the earnings come down, that's where we correct a little bit more and we get a chance to trade the downside a little bit more actively. I think if you'd have to plan it out, that's the way I would look at it. Yeah, so again, here you've got the ES, and if you're looking at it, essentially you would not expect to see very clearly we had a negative close, so that's not a buy signal any way, shape, or form, but you'd expect any kind of weakness to broadly be contained inside this area. This is the famous pretty much 2880. So you'd expect heavy to sideways, but contained inside the zone. And then ideally, if you're a bear trying to build up a short position, you want to see a nice little rip after the G20 into that first week of July, and then everything sell off into when earnings come out, ideally with a lot of gap downs overnight when all those earnings start to get released. Of course, it will also depend on what happens on the rate side with Powell. Do we get a deal? Do we not get a deal? Are they going to cut? By how much are they going to cut? Are they going to start with 25? Are they going to go full in for 50? Are they still, markets pricing in that cut in July, but is it going to be warranted if the market's going crazy after a deal with China, resolution in Iran? We'll have to see. There's just a lot of things that are not that clear at the moment. Yeah, and exactly, and that means that our preferred position has been to try and fade this bond move. No big surprise, but if you look at something like TLT, essentially we're not looking for bonds to necessarily crumble, but we're just looking at, we expected to see chop here inside this range after we got a very, very extended move, and we expect this to highlight that essentially for now we're done and we're going to trade sideways to down inside this range, similar to what we were saying on the ES. Yeah, I mean, and that that takes it back to whatever everybody's looking at and what everybody's talking about, which is the DXY, right? And essentially our call here has been the same for a long time. We've been fairly bearish DXY. We've been shorting every failure at 98 for a move back down into the 96. Our base case expectation is that we'll see a lot of choppy action inside the 98 to 96 until we ultimately resolve in terms of, China, whatever. So for us now, we're trading, we're still inside the range. We're not calling a range break yet. We're more than happy to fade either side of this range. Yeah, clearly, you don't want to fade this end of the day on Friday because, when stuff closes like this, pretty much always it'll gap down. If it closes on a high, smack into the high of the week, it'll gap up. And then if it fails from there. So this is a very interesting day for the dollar because, right, especially if we can hold this little pinch lower and put a little bit of a reversal, then that would probably mean we get a little bit of a breather on all of the other charts we've been talking about, right? Also a little bit of a breather on gold. You'd expect gold to trade and ideally close today below that 1400, right? And if it closes back below that 1400, then all of a sudden you've got a little bit of a room to fade. I still think ultimately our base case for gold is higher, but here this could be a very tradable bounce. Sure. This is our gold chart, and it's probably easier if you look at it on the weekly. And here essentially our base case is that we're heading back towards the 1450. We don't believe in markets that move in straight lines. So here we'd be taking profit on any longs looking to scale it back into the position really. Right now, we were trading, the way we were looking at this essentially was that we were stuck inside 1250, 1300, and 1350 range, right? Essentially what's happened now is we've got ourselves, we got ourselves a little bit of a range shift, and now we're getting the next range shift, right? So you see it's trying to continue to move higher. But for now, as far as we're concerned, as long as we don't get a weekly close above that 1400, we're still trading inside this range, okay? So to make it a little bit clearer, for now, it would be 1400, 1350, 1300. That's what we would be looking at. Again, not because we're not looking for it to go higher, but because we don't believe in markets going from A to B in a straight line. And we like to focus on what tends to happen 80% of the time, not what happens 20% of the time. Doesn't mean you can't make money or lose money either, right? But we try and focus on that. So we always try and play for the healthy move. Now, could gold here just continue to go parabolic, and because of the way it's closed, hold bids, see very shallow profit-taking bids coming back in, and they rip it straight into 1450? Sure. That's not our base case scenario for now. Okay. Exactly. Yeah, I mean, here what a lot of people, and we've discussed it, what a lot of people are trying to square their heads around is, how come everything's getting bid, right? If you plot ES against, yields, 10-year yield, a lot of people are also saying, well, how do you square the fact that the Russell is not catching up with the other indices? It's still weak. What about what's happening on credit? Clearly, those are all interesting charts. So there are plenty of, I think there are plenty of arguments to be made for why the rally is not that convincing. But in the same way, when we're grinding the way we've been grinding higher, right, on low liquidity chop, overnight action on tweets, it's not the kind of move you want to aggressively fade. So clearly, if you're uber bullish, Russell is a chart you have to keep your eyes out on, because we really feel that the sustained break higher is not going to hold as long as Russell is not trading back above the 1600. And so that hasn't changed. That's something you can go back. We've discussed about this in a lot more detail in a bunch of the videos on YouTube, right? But in the same way, right, when we got this, the latest close on ES, if you remember, a lot of people were getting very, very excited about this bearish engulfing here. And we were very quick on the blog, on Twitter, on the video saying, not all bearish engulfings are created equal. How this closed, where it closed, in the context this closed in terms of cyclical perspective, any dip is a buy here as long as we don't get closes below that 50, and we still expected us to go back to new highs. And a lot has to do with the context. So far, this is also still in line with what we've been looking at, and completely in line with what we discussed at the beginning of the webinar, right? So there's no huge change there for us in the way we're looking at that. Sure. Yeah, I mean, here, let's bring that up. I don't know how messy this chart's going to be. I'm not sure I've updated it here in a while, but let's see what we get. Oh no, there it is. Yeah, so here, this is the way we were looking at euro, right? And if you remember, this is also on the blog. Our base case and on the videos was that in the similar way that DXY is range bound, unless we get a resolution or something concrete going on with rates or big change from the ECB, etc., we still expected to stay inside this sloppy range, right? And we said, the weekly closes outside could get very aggressive, but broadly speaking, we still expected to stay inside this range. So here, right, the quick pips to the upside in euro, as far as we're concerned, are done. That doesn't mean it can't extend, right? And again, what's nice in this specific phase of the market is that everything's moving in sync again pretty much, so it should be a fairly easy read. So you see, you get one chart, you got them all, because you're essentially trading this move on the dollar, right? Expectation for rates. So euro's still stuck here, right? And it's still stuck inside this range, so there's not a lot to do. I mean, intraday there's been stuff to do, but here it's just I don't know if you have a specific question on euro. There's just not a lot going on, right? But there's been plenty of opportunities to trade this to the short side, and we were fairly open about this, right? You see every ramp since the beginning of the year, right? That January high, you see how as we were coming back in a descending trend line, we kept on getting these failures here. And until here, it was fairly clear, right? Then come March, it started to get very messy, right? Started to come up, it took out this high. You didn't get it's still the high range got defended, but it got very messy. And here, everything pointed, once we were trading back below, everything pointed that the conditions were ripe or ideal for the euro to get smashed hard. And you have to be very aware of, where the market is in terms of location and what's happening. And you saw here, despite the fact that it had the perfect opportunity to get smashed, what happened once it came back down, you've got this round number is being protected, right? After it breaks through a huge level, you'd expect it'd be like taking candy from kids, right? Clipping this level, and it's not going, right? So you have to start to pay attention. So, you can be very aggressive pressing this to the downside on all these rips, but you're not going to start being, well, at least not the way we trade, you're not going to be pressing it here when it's getting no traction at all, right? So this was really the big tell, this whole base, right? For bam, move, holds the previous lows, and is ripping higher to the opposite side of the range. But right here, I think if you don't have a position on, it's very hard to make a case to really jump in a long or a short here. I mean, if anything, you'd probably be waiting for pullbacks to get long if you're bullish, or starting to nibble to the upside, starting to nibble to the short side if you want to build a bear. But ideally, you'd like to see this pop into the, above 1400s, 1450s. So it's not an ideal location. It's not really an ideal chart here. Sure. I mean, in terms of new stuff to do right here, right now. That's what I'm saying. Yeah, crude This has been responding quite well on the weekly. And again, as we've been discussing on Twitter, you can't really, I mean, you can do whatever you want, but we just don't see any edge in really wanting to be positioned short with what's going on the geopolitical side. And, any tweet could just ramp this up something silly. So we're really not interested in trying to play this to the short side. Having said that, if you're just looking at the technicals here, what is playing out? Well, we had a very nice, very, very technical action where we had this failure on the weekly at a key pivotal level, 62.50. And here it came right back down through the 50 into the 200. And then right into the 200 week, you had this bullish reversal. And now it's popping right back into 50. So this also falls in line with our base case that we're just stuck, right? That fundamentally we're going to be stuck inside this, 50 to 60 range. And of course, it could kind of shoot out either side. But fundamentally, unless something big happens, we'll be chopping around in this area. It's hard with so much headline risk, and clearly would not want to be positioned to the short side because of that risk. No, I don't. Well, anything can happen, but really not thinking about 200 at all. Right. I think if anything, my advice to anybody who's thinking about 200, I'd say you'd have to think about 100 first, and then you could think about 200. But, it could, there's no reason why you start getting some funky action. A lot of people lobbing missiles or torpedoes around. This could pop into 100 in a heartbeat, sure. But, it's hard to play like that as a base case scenario. You have to be aware of what the risks are, but it's not something we would play as a base case scenario. Right, we like to play repeatable setups. We like to play where we have edge, right? We like to play where the market, trying to understand and play for a market that offers asymmetric risk reward opportunities at key inflection points, and focusing on how the market behaves 80% of the time rather than the 20% or 5 or 1%. You don't play for a Six Sigma move, right? Especially if you're trying to do this every day. In a repeatable fashion, of course, sure. Yeah, well, our base case is that since two earnings seasons ago, that it's as good as it's going to get, right? So we fully expect earnings season to bring back some other ugly surprise, or not, at the very least, no super positive surprise. So we're very much looking for the market to stay sideways to bid, but any real nice longer term swing shorting opportunity that is not simply sparked by a tweet or something like that, more structural, we think that will, if it comes, the chances are it will come on the second half of July when we get all the earnings seasons, right? Not right here, right now. I mean, it could happen, but not right here, right now. Yeah, our base case on, which hasn't really changed for a lot of these, but and that probably falls in line also with the call on equities, is on yen. We had been trading yen very aggressively to the short side, and yeah, exactly, and we still we still think that, similar to Aussie or Kiwi, we still think that there's unresolved business, right? People who follow us for a long time know we always like to talk about unfinished business or unresolved business. And again, these levels usually get taken out or retested. So that's still our base case, and it falls in line with our assumption, or our bigger structural views on equities, right? And our bigger view on the dollar, right? We've discussed, again, there are a lot of videos. I'm not going to bore everybody with it. There are a lot of videos on the YouTube channel. So we're still looking for yen to print back up below these lows through 105 again. And we've been very, very, very open about that since the beginning of the year. If you look at the videos at the back end of the year, we went into year-end short USD JPY. Here, again, it's very hard to get aggressively short here. So in the similar fashion to what we've been discussing on all the other charts, right? It's what we're looking for here is, and again, you can put in another line here at the 107, right? As long as we don't break and hold below the 107, we think that the chances are that we're going to go back and revisit this 108, which has been a very pivotal level. And again, here, because we don't believe markets move only in one direction, you know, this could what would be a nice little healthy development here would be to see something like market try, move back here, get some Momo, and then, you know, move all the way back into this whole 109, 108 as everybody regroups, and then we can come back down. Now, of course, market can consolidate or correct going sideways, so it doesn't have to be that way. But also going into the end of the week and the G20, you know, if we get some risk on surprise or something, you know, that could be a nice little scenario where yen holds here, we see a little bit of a correction here, and you get a chance to reshort this higher for the move back sub the 105s, right? So that makes sense. Exactly. That's the way we're thinking of it now, right? Of course, it's subject to change any second, but you know the score. Okay. Any comments? Any questions? Everybody's very quiet today. Even in the webinar, we held a webinar earlier on. Everybody was very quiet. Looks like the markets put everybody to sleep today. Or summer months getting too hot for everybody. Okay, guys. Well, I'll post this on, if you missed the beginning, I think it was an interesting discussion. I'll post this on the blog, on the YouTube channel, about 5 minutes, as soon as it can load. Wishing everybody an awesome rest of the day. Thanks for stopping by. And again, you know, let's see what we get in the markets. It should be very, very interesting. We continue to believe that the back end of the month here, or at least all the way through July, is going to be extremely interesting and offer a lot of opportunity. Have an awesome one, guys. Talk to you guys soon. Take care. Bye-bye.